Okay, welcome everybody to another Learn It Live webinar. My name is Thomas Atkinson. I'm joined by Tyrone Abella, and tonight we're going to be talking about trading the fear index. So how to use the VIX to recognize scalping opportunities. How have you been, Ty?
Yeah, good, thank you. Welcome, everyone. Yeah, tonight is going to be an interesting topic. It could be something that probably a lot of people haven't heard about, but the VIX is certainly something that you could use in your trading to identify really good scalping opportunities. So looking forward to getting into this one because it's a very new topic for a lot of people and something that Pepperstone is about to introduce in the coming weeks. So yeah, looking forward to this one.
So just before we get started tonight, Tyrone, risk warning, the information provided in this webinar or video, if you're watching it on YouTube, has been produced by a third party and does not reflect the opinion of Pepperstone. The information has been provided without any alteration or verification, and it should be considered only general in nature and for educational purposes only. So of course, consult a financial advisor or potentially another financial professional before making any trade decisions or anything like that. So what are we going to be covering today? A few things. First one is going to be what is the VIX, and of course how it has become known as the fear index. Now it has a few different names, but fear index definitely is one, and a few people have tried to dispel that theory, but realistically when the VIX is going up, generally there's some fear in the market, and we'll have a look at how to analyze that later. We also be looking at how you can use the VIX to help your current trading strategies and the correlation between the VIX, indices, gold, and stocks. So it's very, very common that most people will be looking at things like gold when the VIX is moving up, and we'll talk about what usually happens. And then of course we've got our live Q&A with Tyrone and myself. So if you have questions, we'll try to answer them during the webinar, but we're also very happy to answer them at the end. So make sure you get those questions coming through in the chat room. Okay, Ty, so firstly, what is the VIX? So I guess the VIX is basically a live market index representing the market's expectations for volatility over the coming 30 days. Investors generally use the VIX to measure the level of perceived risk, stresses, and fear in the market when making potential investment decisions. So it's really a bit about kind of that idea that if the VIX is going up, there could be a bit of risk off mentality, which we'll cover quite a few times. And of course, the VIX is derived from the price inputs of the S&P 500 index options. So look, generally with the VIX, you'll find that there are other VIXs, but most people always use the volatility index of the S&P 500. It is the most common kind of, I guess, tool and instrument in terms of volatility indexes that most people will follow. And that's just because the S&P 500 is the world's biggest market. And obviously the US still to this day is pretty much the most important market when it comes to if it's selling off, most markets are selling off. What are your thoughts on that one, Tyrone?
It's the benchmark of the world. It still is. Like a lot of people seem to think still that the Dow is, but really the Dow is a representation of only the 30 of the biggest companies. The S&P is the 500 biggest companies in the US. So it stands to reason that it's the one that everybody watches. And the two really move in unison anyway. It's very rare that they actually separate very much. So that's why I think the VIX index on the S&P 500 is the one that is really the one to pay attention to, because like Thomas alluded to, if the S&P is selling off heavily, there's not too many stock markets in the world that aren't. So and for any given reason, so it really is the one that everybody watches.
So I've got a question here straight away, and I will answer it from David. He says, is the VIX strategy only used for stocks or can it be used for Forex? So it definitely can be used for indices, it can be used for gold, it can be used even in currency. Just remember with currency, it won't have the exact same general correlation, but what will usually happen is if you're seeing the VIX spike, you usually see a lot larger moves on currency. And we'll talk about range expectations soon, but that is something that you can consider when trading currency pairs during high levels of volatility. So why is the VIX so often associated with bearish stocks and indexes? So when the volatility goes up, that generally means that the level of risk, fear, or stress in the market has increased. And this is due to potential news event or fundamental results. So what we're going to be having a little bit of a look at tonight is, of course, the outbreak of the coronavirus and what that did to the VIX and how we may have been able to take some advantage of that in terms of trading anyway, from a trading perspective. So how did that impact on particular indexes, gold, etc.? This increase in volatility is often associated to a risk-off approach from investors and creates a selling effect that can often be very quick. So with that, when you're trading based on volatility, you need to be aware, and the reason why we said scalping in this webinar is that often these moves can be incredibly quick. So these moves can happen in a matter of days and then potentially even reverse and then go back down again. So the idea of scalping during these moves is actually a pretty sound one. And it's one of those rare situations where scalping could be one of the best strategies for taking advantage of bearish movements. Markets, of course, tend to sell off faster than they rise. Now, Ty, do you want to talk about this phenomenon?
Yeah, markets in particular, the stock markets very much so seem to fall a lot quicker than they rise for a number of reasons. But one of the main reasons that we've come to the conclusion of is actually margin calls. So in the stock market, I guess similar to currency, the leverage is nowhere near as heavy as it is in currency. So that means that margin calls come in very, very quickly. And quite often what ends up happening is after a day of heavy selling in what ends up happening most of the time in the stock market is the fear of missing out is very, very prominent in the stock market. So when the market's at reasonable highs or all-time highs, what you'll find is that the average trader is trying to get in as much as they can at any given time. So they're pushing their margin loans to the limit because they think at that point, at the euphoric stage, the market is not going to actually reverse. So of course, when it does, it automatically puts a lot of stress, if you like, on the accounts that have entered towards the end of the market, and a lot of those are the smaller accounts. So the way a margin call works in the stock market world is traders have generally given 24 hours to get their money in. So if they haven't actually been able to meet their margin requests in 24 hours, the brokers start to automatically sell their positions down until they're back within the margin buffer. So what that does, it actually forces the market down almost, not so much artificially, but it's being forced down. People aren't selling it because they want to, they're actually being sold out because they have to. So after a 48-hour sell-off, it actually stands to reason that 3 or 4 days of very heavy selling comes into play, mainly because of margin call rollovers. So that's why you do see very, very sharp drops in the stock market world and the indices if there is a couple of very fearful days. And that's where the VIX index really comes in and goes through the roof at these periods.
So as we mentioned before, Ty, the VIX index will be coming to the Pepperstone platform, hopefully in the next coming weeks, if not months. And what I've done is I've actually taken a few different snapshots for tonight, and then we'll correlate that back into the actual markets and what's happened. So I want to show this to everybody straight away. And that's because if anyone's never looked at a volatility index before, then what you'll notice is there's these large spikes that happen. This is actually a full monthly one, and it goes all the way back to the GFC, and of course, some of the big spikes that have happened since then. And what we can see is the GFC was out of control. So easily the largest spike, very, very large in terms of the volatility on the market. And it was quite a long time it stayed volatile. So often with the VIX, it's important to notice that when the volatility spikes, it may only be spiking for a short period of time. So each one of these is a month, and you can see that generally it's that kind of 2 to 3 months time frame, maybe 4, whereas during the GFC there was some serious spikes, and then it went, of course, out of control near the end, and that created that massive volatility that we saw. All right, I'll get rid of that one. Okay, so here I've got just a daily chart up, and I've just highlighted down the bottom kind of this level of 12. And what you'll see is that the market seems to like reaching in terms of volatility. When everything's good and everything's well and everybody's very happy about the market, then we usually seem to be reaching this kind of 12 level. And then when something is spiking the market and causing, let's say, a bit of concern, then we generally see it bounce off that kind of 12 level and then start to move at least towards that 20. I think we'd all agree that 20 seems to be the kind of area that it goes for, at least initially anyway. So here we've got the outbreak of the coronavirus news, and you can see it very quickly moved up over the weekend. it gapped even higher. It stayed volatile for a while, and now, depending on how you see it, I guess, the volatility is coming out of the market. But for this period here, we could definitely be looking at certain types of trades on certain types of pairs and taking advantage of that. So we'll break this down even further now. Hopefully that does make sense to everybody. So when things are pretty stable, generally you'll be seeing it around the 12. What I like to think of is if it's in that range between the 12, 14, 15 kind of range, usually the market actually will be very technical as well. So you'll get some great technical opportunities in terms of it'll be doing its normal ebb and flow, its normal movements. Fundamentals will definitely be playing out, but also technicals will be playing out well. So if I think at the start of this year, Ty, we saw some great technicals in January. Pretty much in the middle of January, early January, was some amazing technicals, weren't they?
Yeah, most definitely. And look, I'll tell you one thing about the VIX index actually, and probably speaking of technicals, it's probably not something that we've really looked at in terms of how technicals actually stand up to actually trade it. Because the one thing that you're going to be able to do is you're going to be able to trade this this VIX index shortly, and I think it's going to offer some really, really good opportunities to potentially do mean reversion trading. I think it's not going to be as technical as what we're predominantly used to, but I think it's going to give some really, really good opportunities, especially when it does spike, to do mean reversion. So it's going to be quite an interesting time. What we'll be doing probably once it is up and running, I'd imagine we're probably going to start using it in some of our analysis in future webinars as well. So absolutely. Yeah, really looking forward to getting stuck into it. Yeah.
Yeah, so here, look, just even here, Ty, and even over here, what we'll notice is it's staying within that band. So it's kind of in that channeling band. Then when it breaks out, generally speaking, when it's breaking out of this, especially when it's in a really nice, well-contained band with really great resistance points, it's very, very, very stable. And then it breaks out and then it goes on that nice kind of big bullish movement. And it's done that a few times. So if you do see a bit of a range kind of in this zone, it's definitely something that you can then apply that, have a look at it on this particular chart, and then maybe assess maybe gold or an index or something and say, well, is there an opportunity that's even better considering what I'm seeing on this volatility index? So definitely something to be looking at. All right, we'll go back into the slides and then we'll come back and revisit the VIX, and we'll also then start looking at some of these market examples for everybody. Okay, so how do we want to trade the VIX with our current trading strategies? So we want to recognize the current levels of the VIX like we were discussing then, and whether it's in a breakout or a low level. So if it's in that kind of range that we were discussing, it's probably more of a technical market. There's probably not going to be any unforeseen large moves, at least at that period in time, and you're going to have that normal ebb and flow in the market, which is good. It definitely gives you great trading opportunities. Then we might use our knowledge that if the VIX is in a breakout or trending upwards, this will generally mean a larger range for pairs such as stocks, indices, and gold. And also, of course, trades in this volatile direction, e.g. bearish on the S&P 500, will generally be more aggressive. So it's very important that we understand that if we're starting to trade based on the volatility and we're trading that breakout, that we want to be in and out relatively quickly, but we also want to probably cut our take profits slightly shorter. So if we expect, let's say, a certain move to happen, we may only take, if it's against the direction of the bearish movement, let's say on the S&P 500, we would only want to be taking 80%, absolutely, of what we expect. And if it's in the direction, we might want to scale out of some of our order and then leave some on, because of course, when these movements happen, they can just continuously go. So it's a good opportunity for you to leave potentially a little bit more on, but also to take that conservative kind of idea of break evening the trade or moving your stop loss down behind the swings, that kind of thing. You definitely want to be thinking about that. Of course, the correlation between VIX, gold, indices, and stock. Generally, if the VIX is rising, the following things will happen. Gold strengthens as it becomes a bit of a hedge trade. Indices drop as a risk-off approach starts to happen, and then people lock in profits or close trades in fear. And of course, stocks generally drop in line with the indices, with specific stocks most at risk of the current volatile news losing more than others. So what we saw recently, Ty, was stocks like, well, in Australia, I guess it would be Qantas, were definitely getting hit a little bit more than other stocks because they were related to tourism. And of course, the coronavirus is really potentially hurting the tourism industry with people not wanting to fly and people being very aware of those things. So you need to be a little bit aware that if you are trading stocks, what type of stock are you trading? Will that be more or less affected by the particular news that's come out? And therefore, if it's more and the volatility index is spiking, then generally the move will be even greater and it will give you even more opportunity. Of course, market conditions we're looking for scalping. If the VIX is trending, then we'll be wanting to look on that larger time frame for the trending. And then we choose the time frames for the setups. So usually 5, 15, 30 minute and 1 hour time frames, and that will give you plenty of opportunity for trading. This is just another example of what a channeling market looks like, similar to what we saw in that VIX with that buy or breakout zone. I'm sure many of you are aware of channels, definitely something you should look at. And we've got just a double bottom pattern here, often happens on the VIX as well, and the breakout and what you'd be looking for. All right, Ty, so let's get back into the market and start taking a look at some of the things that have happened recently. So we'll actually grab a 2-hour chart up here of the VIX. And this is, of course, January into February. And we can see that that spike over 15 happened. We had that weekend from the 27th in. And then, of course, we had this extra little kind of peak momentum around the 31st of January. So hopefully everybody can see that. Let's highlight that there. Another spike around 31st of Jan. So let's now have a look at some of the markets and see what they were doing around the 31st of Jan and whether there was any potential opportunity for us.
Actually, while Thomas is quickly doing that, I'll just quickly mention we're getting quite a few questions about the current markets. We've got a live market analysis webinar starting in 45 minutes. So for anybody who would like to join that, I'll pop the link in the chat room. But we're not addressing any currency pairs or anything in the live markets now, because this is more a VIX learning webinar. But if you'd like to join us for our live market analysis webinar, I'll pop that in the chat room, and you can basically click on that and you can join us in 45 minutes.
So we saw a very similar thing, Ty, where we had that kind of resistance break on the 15 and it came back and touched it. And this actually happened on the 29th, just because I've got an example on gold. And then, of course, we had that 31st as well. So if we go to gold, there's actually a great little pattern that's here. And I'll load up this flyer that we made a while ago. And if anyone wants this, Tyrone can post it in the room. It's absolutely free. And we've got all these different patterns that we can be looking at. And we love pattern trades. We love them in scalping. We love them in really day trading. Doesn't matter what you're looking at. And this is probably more of a day trade. And generally we'll be day trading actually a lot more with high volatility. But you can see here there's the inverse head and shoulders pattern. And you definitely should learn about inverse head and shoulders patterns. And all the ones really on this sheet are very, very good for you to look at. So definitely worthwhile. But here we've got an inverse head and shoulders pattern, followed by a break of the neckline, pretty much broke here. And then of course it retraced, the stop loss would have held easily. And then we see that nice big move up on gold. Now that happened at the same time that the volatility index was spiking. So of course we expect that gold will generally be spiking or moving upwards if we are seeing an increase in volatility in the market. So that's a really great pattern that happened at the same time the volatility index is spiking. So what that does is it helps us gain confidence in our trade. If we know that the volatility index is spiking, we know that generally that will mean that gold is going to move to a bullish momentum. And we see a pattern like this occur in the direction that we want to be in, it's on a 15-minute, does that give us the confidence to be in that trade and the confidence that most likely this will be a successful trade? It absolutely does. It also gives us that ability that even if we got a bad entry, generally speaking, that volatility will push the market in the direction that we want. So you can see again on the 31st, which was that other time the volatility spiked, all of a sudden the 31st, it's come back to this line and then boom, onto a new high. There's not as probably as good an example of buying here as there is with this inverse head and shoulders, but I'm sure on a 1 minute, 5 minute chart, this is effectively a little range bound market. And then of course the range breaks here and bang, we're off in the direction. So really when you're trading in the direction of that volatility, it will just help you quite a lot. What are your thoughts on this one, Ty? I mean, definitely that inverse head and shoulders is the beauty, isn't it?
Yeah, absolutely. You know, it played out lovely, and we had a lot of traders actually trade that. It did correlate perfectly, but these patterns seem to happen all the time, and this is why I think this is going to be a big key to people's analysis moving forward, because it does, especially on the gold and the indices, it really is going to give that turbo boost to some of these patterns when you do get that spike that we've been talking about over the 15 and the 20.
Another question that we get asked quite a lot is, does volatility potentially spike currencies, Ty? I'd say there's a lot of currency traders here. So on the 31st, we actually had another pattern on the US dollar index. So we actually had a nice little inverse head and shoulders here as well, and that broke at the same time. So we had the left shoulder, right shoulder, and then pretty much the break came through here. So when that break happened, it pretty much happened just after the 31st. So again, to that volatility, and sometimes you will see US dollar strength as people pull out of the market. Usually what happened is people put money into cash, and you would see US dollar strength in times of volatility. But I found over the years that since ever QE started and all these things, Ty, I think what's more likely is that gold definitely is very solid with the VIX, and same with the indices. And really what you're expecting in currency is just larger ranges. So more volatile trading, as in you can expect, instead of the range being maybe 60 pips like it was 2 weeks before, it might extend to being 80 or 90 pips long. I think you'd agree with that one, Ty, wouldn't you?
Yeah, definitely. And look, the dollar index is something that should be watched and talked about anyway. But I mean, there's inverse head and shoulders playing out everywhere on the index, and you can bet your bottom dollar it's going to react similar to gold will when these happen. So as much as it's not a currency pair, it's certainly a tradable instrument. And I'm not sure how many people here are trading, but if you're not, it's certainly something to look at, because we are going to do future information on how much of the currency pairs actually make the dollar index move. The euro is obviously a major player in it, but that's not a topic for tonight. But it's certainly something to keep an eye on, because it is another key indicator, if you like, of what's actually happening in the overall markets and the currency markets.
So again, we'll just go back to this chart of the volatility index, and we can see, of course, that spike. We had that spike in the 29th to 31st. So this time we're on the DAX. So, the German 30 in terms of the Pepperstone platform. And we can see it broke through on the 27th, but then we get this really great potential entry. And this is a role reversal entry. Yes, I know this is the 4 hour, but of course you can drill this down to the smaller time frame. And what we've seen is a really nice break of support and test of that support, which is what we call role reversal. So we've got that first touch, second touch, third touch, breaks through, comes back, consolidates at this zone, which also turns out to be our moving average area. So there's a 20 and a 200 moving average here. And all this happens at the point that we expect what's called role reversal, where support becomes resistance. Now, because we know if the volatility index is spiking and going to a higher level, what does that mean for the indexes? It generally will mean that the indexes are bearish. So if we're seeing a trade in the direction of the bear and down, and we're seeing a very good technical trade at the same time, that's a great opportunity for us, isn't it, Ty?
Yeah, most definitely. And it is about that cross correlation that is going to make this so powerful. And look, I know we're talking a lot about indices tonight, but look, they're becoming very popular. And realistically, what we've found in the past and with a lot of our trading is that the technical setups that we talk about and we do a lot of webinars on do play out in the indices, just as accurately as they do in currency, if not more so, because they are more steady. So for those of you who are new to potentially trading indices, even as a whole, if you're used to just currencies and you haven't really delved into the index world, Pepperstone offer all of the different types now. Like they've got a very, very big broad range with really, really tight spreads. So we'd encourage you to really start looking at them because they are very technical in the way they set up. And yeah, in a sense, they're actually quite, I guess, easy to trade in that regard because patterns do hold up very well, don't they, Thomas?
Yeah, patterns hold up incredibly well. So and specifically if you're looking at things like the VIX as well, Ty, and you do notice that volatility spike and you see things like role reversals in the direction, I mean, it's a very good type of trade, and it can often be over quicker than expected. So here we see with this DAX, a misconception sometimes with indices is, oh yes, but that's more of a trade where if I want to be in it for a year or a couple of months or something like that. When it comes to volatility spiking, generally speaking, you'll see large moves on the indexes very quickly. So it gives it that, if you want to be in and out faster, it gives you that opportunity to trade it that way. Now we can see, of course, everything's reversed after the volatility stops, in terms of people stop to be scared of particularly the coronavirus in this case due to a few factors. And what's happened is it's spiked up, and of course it's made a new high. And this just really reiterates that if we were in this trade to the short, we'd be really targeting the previous lows over here, and we would generally get out of that trade, and we would say, okay, it's a scalp, it's a day trade, get out of this trade and move on to the next one.
So Thomas, just quickly, a couple of people are having difficulties finding the links that we've posted. Do you want to just talk them through exactly where they can find it? Because we're just having a few questions for people saying they want the cheat sheet and they also want the registration link, but they're just having trouble finding it. Can you see it on yours?
It should be in the chat window.
Yeah. Just in the chat window, guys. So check the chat window, yeah. And the cheat sheet is there for you, and it's free, and it's a really good way to actually probably go through it and actually even look at the indices. And yeah, when you do get the VIX up, we do really encourage people to actually overlay, do a little bit of what we're doing tonight. This webinar is going to be available on the Pepperstone YouTube channel, so you can go back and review it anyway after tomorrow. But we really encourage you to actually go back and do some research when it does become available on the Pepperstone site. Go and actually check some of the big market moves on the indices and see how they did correlate to the VIX. I think you're going to be very surprised at how often they play out exactly how we're talking tonight. It's going to be a very good resource.
So Ty, back onto the dates that we were discussing, 31st, and that of course beforehand more around the 27th, 28th. So 31st, we know the volatility index spiked. We're on a 5-minute here, and we're sitting on the US 500, S&P 500. We definitely have a bias towards the short side, okay? When we're seeing the volatility index spiking, we have a bias towards the short side. And this is just a great example of a little scalp that pays off really, really, really well. And that's because it's in the correct direction and you've analyzed the charts well. So you've got this little double top, intervening trough, close, break through. At the same time, your moving averages. These are the 20, 50, and 200 moving averages, by the way. And they are, they haven't quite crossed, but they're breaking through. And we see that close, and that might be your trading system. We're taking little kind of pattern like this in the direction of the trend. We're happy with the moving averages as well, in terms of that's acting as a dynamic resistance, and it's coming through. So we get involved here. Usually our take profit would maybe only be this, but because of the power of the volatility, the market has easily broken through this point, continued on, and then gone all the way to a much larger time frame support. And that gives us that extra kind of risk reward that we really would like to have in scalps. So volatility definitely gives us the opportunity if we trade the right direction. Now, I generally would not recommend you trade against the direction in terms of you're looking at the buy side with the US 500 or something when the volatility is spiking hard. What you would generally be looking at instead is looking for reversal patterns on the larger time frames, okay? So you may not get the lowest point down here, but what you might do is you might say, okay, when the market breaks through this resistance up here, it broke through, comes back, roll reversals, that's our buying opportunity, because the market down here, we don't want to be catching that falling knife. We can trade the knife down, but we don't want to catch it. So here we might start to go looking for buyers again, and you'll probably see the volatility index decrease as well. Hopefully that makes sense, but we don't want, in this area here when the volatility is spiking, we really would prefer to be bearish, and you can see that the bearish candles are incredibly large and very, very fast generally. All right, Ty, so just quickly look at Apple. I want to bring Apple up. Everyone likes trading Apple as a stock. And again, we'll just focus on the same date. So we'll focus on that kind of 31st date because that's where we saw that spike in the volatility index. And we'll jump down into the smaller time frames. I'll just quickly set this up for everybody. And again, we see a very similar kind of thing happening, where basically what's happened is we've got this kind of little bit of support here, a lot of moving averages, a cross of the moving averages to the downside, followed by the candle here piercing our 200 moving average, making a new low, and of course a very, very quick sell-off. So again, we could be in the smaller time frames, maybe 15-minute, 5-minute. We could have a reason or a strategy to go in the direction, but as that volatility index is spiking, generally it will continue spiking. It won't just go up, down straight away. It'll usually follow through a little bit. So again, we recognize that VIX indicator is pushing up, and then we can trade things like a stock potentially to the bearish side. All right, I'll go back into the charts quickly, Ty, and then we'll talk about setups and what we'd be looking for as a few examples. Okay, so role reversal, definitely something we could be looking at in the direction if we see the volatility index spike. Of course, things like support becoming resistance or resistance becoming support. So if this was gold, resistance becomes support. Let's say we saw that volatility index spiking, definitely could be taken in the direction. Another important thing when it comes to trading with VIX type trades is we want to enter based on confirmation, not on gut feeling. So whenever you're looking for a break of a pattern towards the direction you want, or you're looking at anything really in terms of a close of a candle, maybe it's a shooting star or a hammer or something like that, we want to enter based on confirmation, not on gut feeling. So wait until that particular period or time frame closes. Then when it's closed, you can enter the trade. And of course, you don't want to generally break even trades with a fixed pip amount, especially when the volatility is high. Use percentages. So if you have, let's say, generally have a 15 pip stop or 20 pip stop for your scalps, think about the candle that you're trading and then use a percentage based on that candle. So maybe you say, okay, this candle is 20 pips long or 10 pips long, I would like to have a certain percentage behind that candle, or if it's a pattern, you take the distance of the pattern and put it a certain percentage extra behind that pattern. Okay, you want to also create trading systems based on multiple entry criteria during any time of your trade. So we always talk about this, set up some kind of point-based system for your trades. It doesn't matter whether it's a volatility index or a style trade, or you're trading indexes or you're trading stocks or whatever. You want to have usually things like maybe 2 or 3 reasons to be in a trade. So patterns, double tops, double bottoms, head and shoulders, etc. Support, resistance or role reversal, candle confirmations, and Fibonacci retracements are all very, very good, and they work very, very well in volatile times as well. And of course, Ty, we've got a few advanced trading tips here as well. But before we do that, we've got a few people that want to talk about a particular trading strategy that you could use during the volatility spikes. So Ty, what are your thoughts on some of the best kind of systems when trading volatile markets?
So when you are, I mean, look, obviously breakout strategies are going to be the ones that you're really looking for when you're using the VIX as the overlay. You're going to be looking for those breakout strategies because the VIX is going to break out of a zone. So generally, what you do find is that when the market is quiet and the volatility is out of the market. Now you've got to remember, because it's based on options trading on the S&P 500. When the VIX is actually at those lows and tracking at a very small range, it means that the premiums on all of the options that are being transacted are very, very low. So it's almost like options, I'm not sure if people are aware, but they're almost like an insurance policy. That's how they're often used as a bit of an insurance policy. So in to give you a bit of an example, if you were living in a very low crime rate city, insurances are going to be a lot cheaper to purchase than they are in the middle of a very highly volatile crime-ridden city. And that's a little bit the same. When the market's actually becoming volatile, insurance premiums go through the roof. So options pricing goes through the roof, which is what makes the VIX move. Now, in quiet times, the market is obviously generally in a consolidation zone. So what you'll find, a lot of the indices will be in a bit of a consolidation zone. So you're going to see a very similar breakout on the indices as you are on the VIX. Now, you've got to remember they're not going to go in the same direction, because what you're more than likely going to see, like we explained earlier, is if the VIX spikes up, it doesn't mean that the indices are going to spike up. They're generally going to spike down because it is a fear index. And when fear enters the market, that's when people start to want to protect their positions. And to do so, a lot of people start to purchase put options. And when the put options the buying starts to go through the roof, that's what makes the VIX go up. Now, of course, fear leads to generally panic selling and also market shorting, like we talked earlier. So it's the breakouts of the zone. That's probably the most basic strategy that you'd want to be looking for when you're applying a VIX strategy, because indicators aren't going to help you as much, mainly because they're not going to be reactive enough. An indicator. A standard indicator is a reactive indicator because it's lagging what price action is actually doing. So by the time you see a moving average cross or a stochastic cross in the right area, generally it's going to be too far gone. So the breakout's the one you definitely want to be looking for. So price action is definitely what you want to be looking for in those instances.
I think we'll just go back to gold again, Ty. When you're talking then about breakouts, I've just drawn this line here. And again, one thing that we always talk about is if you have multiple levels of resistance or multiple levels of support where it's hit it multiple times and then it breaks through, it means so much in the market. So here we've got basically two peaks, two resistance points, and this happened before, of course, the Corona news really broke out. And we had that first touch and we had that second touch. Then we get that volatility spike that comes into the market. That's when the volatility started, around this 24th of Jan, 23rd of Jan. It comes through, it breaks, and it closes above. Now, what we could do at this point is we could say, okay, this is closed above the previous resistance points, and it has not done that before. So this is clearly a breakout. It's pretty much been in a bit of an uptrend, at least on these on this time frame, the hour, and it's obviously been in a very large uptrend on the larger time frames. So we've got that breakout. We could potentially say, okay, we want to buy this opportunity, and of course we do so, goes into the weekend, gaps up, and gives us a very healthy kind of trade there. But you don't always know the gap's going to happen or any of those things. The main thing that you've done is you've analyzed the VIX, it's going up, and as Tyrone said, the breakout strategies are the ones that you want to use during this time. So if it was the S&P 500, you want to look for multiple levels of support. So let's say we were here, this was the S&P 500, and we have kind of this point where there's 1, 2, 3, 4 kind of touches of this support, and then this candle broke through, closed to a nice low. Do you think that could potentially be a great opportunity for us to take it? The VIX is spiking, it's starting to spike. We see the close below. Will that continue to be a pretty good trade? Generally speaking, yes, because the volatility index will usually continue to spike through that point. It's broken for a reason. There's usually some kind of news. The market usually panics. And nowadays there's a lot of algorithms in the market. There's a lot of robots trading the markets as well. And I've noticed that the markets have a tendency to overshoot, Ty, and they move very quickly now, don't they?
Yeah, they certainly do, and especially like we've mentioned a few times, especially when there is fear in the market. Once that kicks in, the markets start to really overshoot. Most recently they've been returning to their like you'll see a market overshoot and then return very, very quickly as well. So it does work both ways, but definitely it seems to exaggerate the move in the first instance.
So just some advanced trading tips before we go to questions, Ty. We want to look at the larger timeframes, and we always say this, even if you're trading smaller timeframes and scalping, make sure you're aware of your key supports, key resistances before trading any of those stocks, indices, or of course, gold. Use the 80% rule when considering take profit zones. Try to take most of your trade off a little bit earlier than you usually expect because it's volatile and it will spike each way. And you can also play with the idea of maybe leaving a little bit on, breaking even your trade and trying to, I guess, ride that wave of volatility. You also want to be considered gapping, and this comes to people that are trading currencies as well. If you're somebody that holds trades over the weekend, specifically if you're holding things like gold and the indexes, stock, or maybe even like a current currency that has a large range in it, you must consider gapping. There have been some big gaps recently, again, due to the volatility spiking, and that can hurt your account because remember, it's closed during the weekend, and whatever it closes at and whatever it opens at can be very different. We're going to look out for red news, especially stuff that could, I guess, increase the fear in the market, because that will be very important. And of course, we also want to trade liquid pairs. So if you're trading the majors or you're trading those indexes, you're trading incredibly liquid pairs. But if you're trading a side pair or something that's a little bit more exotic, you need to be very careful because the chance of gapping or illiquidity becomes higher during periods of fear. So you probably won't experience this, but I do remember there was a period of really large fear and there were some emerging markets that were being traded and people were removing trades from that, selling up, and there was periods of illiquidity. So people couldn't get out of those trades. And of course that creates a flow on effect. So we always need to think about that. These are just some kind of market conditions we generally look out for just in general. And of course, we do have a Telegram group, so you can feel free to join the Pepperstone Telegram group, which is great. It gives you some daily tips and all of the stuff that they're producing, which is excellent. And we also do have a public Telegram group that people are free to join as well, if you're interested in getting involved in a bit of a community as well. Now, Ty, we always talk about Pressig. We'll not have too much time to talk about tonight, but basically you want to create a business plan for any of your trading strategies. And having a VIX trading strategy or a volatile time trading strategy is really important as well. And you want to have as many reasons as possible. So of course, we have price action, risk management, ELD in our course, chart patterns, indicators, and charting techniques. So we have all of these things. We usually recommend you use one of each one of the letters before placing a trade, and you try to find a reason, so as many reasons as possible to be in those trades. Risk management strategies, pretty common. Just leave this up here for a few seconds and then we'll go to Q&A. So Ty, do we have a couple of good questions there?
We do. We've actually got a few questions here on when it's going to be available. Has come up quite a bit, so it's coming in the next few weeks. So we haven't been given an exact date, but we're expecting it within the month. They say that it should be in the next couple of weeks. We're not sure on what the code will be for it either. I know a few people have asked that. But more than likely, it's going to have VIX in it somewhere, I would expect. But we can't give you that. But when it does, look, we're going to put out an announcement. Pepperstone will send out an email in the newsletter to tell us that it's available, and we'll certainly be mentioning it and keeping everybody in the loop in the coming webinars as well to make sure that everybody is well aware, because it's something that you're going to be really able to use as part of your analysis. We're very comfortable with that. We've got another question. Quite a few questions are coming through about the moving averages that we've used on our technical analysis charts. We always use a 20 and a 50 EMA. So the red and the blue is the 20 and the 50, and the green is 200 SMA. Okay, so that's pretty straightforward for all of our charts. We keep ours very, very straightforward. And if you are joining us in our technical analysis market wrap in the next 20 minutes or so, you will see those moving averages on all of our charts. We do stick to the same ones.
So I've just copied in both the Telegram groups, so definitely feel free to join the Pepperstone one and even else. Now, Ty, got quite a few questions, things, okay, about Bollinger Bands. Yep, definitely do use Bollinger Bands. They're a good indicator, so worthwhile looking at. It's not too bad also in volatile times, but you'll find again with most indicators, be careful with them because they are usually lagging a little bit. And I think you've answered a lot of the questions that have been asked, so that's great. I would just like to reiterate, for all those currency traders out there, volatile times equal larger ranges. I really want to stress that point. Larger ranges mean potentially larger profits in terms of course, the movements that can be had. So if you're getting in and you expect usually like a 30 pip move, it may be bigger because of the volatility. So yes, we didn't cover too much currency, but definitely the volatility can help for ranges in the markets.
Yeah, I think when it becomes available, we'll do a little bit more on it, and we'll send out another webinar and actually maybe do some cross-referencing and have a look at them relative to each other at the same time as well. I think that'll be a bit of a difference. So we'll certainly incorporate it in some of the future webinars coming in.
All right, last question here, Ty, good one. Murray asked, does the VIX lead, i.e. the VIX up before gold? Actually, it's very similar to kind of the two oils as well. Sometimes one will lead the other, or the US dollar index, let's say, will maybe lead the euro, or the euro will lead the index. So why you want to do this cross analysis is sometimes you will see a spike or a movement in one particular cross pair that you're looking at, or something that will tell you and give you a hint, hey, we want to be looking for opportunities on this particular pair because we've seen that break happen. And I think that's probably one of the biggest benefits of doing VIX analysis. What VIX reading is considered higher volatility in the FX market? Probably over 15. I mean, over 20 definitely, but over 15, depending on the one you're looking at, yes. But generally, over 20 is certainly very, the fear is definitely rising quite hard. All right, Ty, well, I think that probably ends us for this week. We'll see everyone next fortnight, and we do look forward to having, of course, the VIX on the platforms. Hopefully everybody does enjoy that edition by Pepperstone, and hopefully everyone enjoyed tonight's webinar, and we look forward to seeing everybody either a little bit later in about 15 minutes, or of course, in 2 weeks' time for another one of these great sessions.
Great, thanks for joining us, guys, and have a good night.
Thanks, everybody.